Hey, there we go. Hello, hello. Welcome. Welcome. Happy Wealth
Hello.
Wednesday. Happy Wealth Wednesday. We've been over here jamming to music about money, getting ready for this session. So we're all very energized. Good to see you guys. Thanks for sharing your lunchtime with us today. We're going to wait just a few more minutes, and then we're going to get the party started. All right. See, Jordan, we're going to have to pipe in that music that we were dancing to earlier.
Yeah, a little bit.
Maybe you can sing for us.
You don't want that. You hear my
Money,
voice
money,
right now.
money. I think that would definitely add a little bit of oomph to the midday as we get started talking about money. We will definitely do that for next time. That is for sure. That is for sure. So for those that have joined us, the chat is our friend. So we're going to ask you to pop things into the chat as we go. Watch it. For any information, drop your questions. We're going to be doing some polling. And so we will be using that a lot. So open that up and have that available on your screen. We're going to be monitoring that throughout. And this is a fair exchange of information. So it's a conversation, it's not a lecture. And if there is something you want to know more about, we have short time to talk today, but if there is something we can hit on, we definitely will do that today. And if not, we can always take it offline and talk more about it. So for sake of time and everything that we have to cover, we are waiting for a handful of people, but they could just pop on in when they get here and we pick up where we're at. So welcome to Financial Protection. I call it Financial Protection and Security. My name is Lisa Lickert. I'm the founder and CEO of Unique Growth, and we provide financial coaching and advisory services to all. We're very unusual as a financial services firm. We do not have limits or caps of what you have to make or we currently make in order to be eligible to work with us. So getting us started today, let's talk about what is on our agenda. So you were asked when you registered to fill out a survey. And in that survey, I was able to collect information and details about your needs and wants and what you wanted to experience when we were together today for this hour. And so I laid out the agenda to make sure that we covered those areas. We are going to talk about how to protect what matters most, plan for some unexpected situations, a few strategies on tax advantages and lifetime income, and then really kind of talk through what it means for you to take control. QR code there. If you would like a free consultation, please let us know. Obviously, this is why we're doing this. We want to build relationships and earn your trust so we can help you on an individual basis. All right. So what is protection? I think we all know it is just preparing for those things that happen in our life, whether it be accidents or illness or something that's going to harm our financial situation. It's important to be proactive, but many times in life we have to be reactive. So we're just doing our best in these areas to plan as best as we possibly can for what is to come. There are three pillars that we talk about, and the first one is your income. That is the main pillar, right? So that's the money coming in. And if you think about how important that is to protect, every dollar you save, you really have to save $1.25 or $1.50 because of your taxes, right? And so that's a big deal. And then when you think about inflation, right? Inflation increased by 3%. So when you're looking at your money and your income, how the heck do you protect it when you have all of these forces kind of working against it? And then if something happens to you, you still have to put food on the table. And so how do you protect that income so you are covered during those periods of time? Now, health. Health is another pillar, and I think we can all guess why. Many things are changing in our lives. Our lifestyles are changing. We're not as active. There's a lot of processed foods out there, a lot of chronic diseases, a lot of things. Even though we're each trying every day, we're trying to do better, life happens. And then legacy. Most of us that have children and grandchildren, and we're thinking of ways that we can not only protect ourselves in this life, but how can we help them when we're gone? So legacy building is extremely important as well. So those are the three pillars. And before we dive into some of the content, let's do a poll. What percentage of Americans do have a what percentage of Americans don't have a financial protection plan? So is it 20%, 45, 60, 75? Let us know. And right. All right. So the winner, chicken dinner. Oh, we still have a race. Hold on. We still have a race. All right. So the poll, I'm going to end the poll at 45%. At 45% of Americans do not have a financial protection plan in place. The reality of it is it's 60%. So that is a pretty large number. And a lot of times it's because there's so many priorities and so many conflicts that happen within our daily life and our financial landscape that really prevents us from having that plan in place. And so a lot of the work that we do is just making sure we kind of figure out how to make that fit and what is that protection plan for the individual. All right, coming back here, there we go. So we think of it as a balancing act. If you think about financial security as these like three buckets. So one is your income, right? You want to make sure you're maximizing your income here as you are in this life. And then you balance that with then leaving a legacy. How do you build wealth, not just for yourself, but also for those you are leaving behind? The second bucket, if you will, is that growth and protection bucket. You want to grow your money and you want to grow it as fast as you possibly can, and you want to maximize it. But at the same time, in different stages of our lives, you got to protect that money too. You don't want losses during a time you're getting ready to retire, for example. So that balance is important. The third area that we look at is that money for me versus money for the IRS. We have tax obligations, and I'm not suggesting breaking the law, but there are many ways that we can, again, maximize our money for us, all while complying with the IRS. What's your most valuable asset? We all know what the answer is to this one. It's your income. Again, you have to put the food on the table. So that's what we're going to focus on, and that's going to be at the core of everything we talk about when we talk about financial security and protection. All right, here's an example. Now, not everybody makes six figures, and nor are they 30 years old. But this example here is a 30-year-old making $100,000. You're really planning that income protection around that 10 to 15 years. There is a worksheet that we go through to really kind of calculate what that means for your situation. You're talking about things like your debt. How many years of income replacement do you need to think about for your family when you're gone? Depends if you have younger children versus children that are already graduating college and those types of things. So you can understand the various factors that come into play, but a pure calculation is your gross income for at least 10 years, sometimes 15 years. So that is your most valuable asset. So of course, we're going to go into talking about then how do we create lifetime income? What are some of the things that we could be doing to think about how we create those lifetime income streams? It doesn't automatically have to be when you're retired. It can certainly be during your life today. So we're going to look at a couple of things. We're going to look at about how can we diversify your income streams? And this doesn't mean you're going to get a side gig. That's not what we're talking about. But we're talking about where your money lives, what portion of your money that you have within savings or investments, and how we can either maximize those money or get you started to where down the road, when you need it the most, you can have multiple streams. Example of this, you have a savings account. Do you have it in a high yield savings account that's growing at about 4.5%? Wouldn't you like to be able to have an extra stream of income of dividends over that account? A brokerage account. Do you have it in just a 401k right now, or do you have a brokerage account? Brokerage account pays dividends. 401k has some restrictions. So we take a look at what's going on, again, in your financial landscape, and we look at that balance. Remember those three buckets, and we're just making sure that everything is in line for you. Doesn't all happen at once. We definitely step into it over time, but we want to plan for the future and make sure we diversify income streams. Strategies for guaranteed income. A lot of people don't realize there are strategies for guaranteed income beyond Social Security benefits. Now, we can debate all day long what's going to happen with Social Security benefits and what's going to happen with the calculations down the road based on our financial situation or economic climate right now. But that is an income stream, and that is a guaranteed income stream. And so that's just one. And that's usually what people think about when you talk about guaranteed income. But there's also a lot of financial vehicles out there, like annuities, that still have high growth, where you can invest your dollars. And even after those dollars, although they're accumulating and growing, even after they run out, you still get paid income for life. So, and then there's systematic withdrawals. A lot of people think, okay, I need this much money a month. And so I need this bucket of money, and this is what I'm going to be pulling out. Or I have this expense, so I need this much money. Well, at the end of the day, we can have systematic withdrawals with multiple accounts that still help your money grow, but yet you're getting the income that you need for life. And so that's another guaranteed income strategy. There's just a lot of considerations. And so some things that you consider. Inflation, I just mentioned that before on the other slide when we were talking about the 3 pillars. You want to review it all the time. So this isn't like set it and forget it at all. This is set it. Sometimes when we set people's plans, we're really working on more like debt and credit and savings and those types of things. And so we're going to review in a year's time, maybe 6 months' time, in order to start then stepping into their financial roadmap. So review and adjust is extremely important. And I would not do it less than once a year. And then there's long-term care, there's tax liability. We'll get into tax liability. Long-term care, a lot of people forget about this because they do believe that either disability benefits through the Social Security Administration or maybe some state-funded programs are going to help them if they have a health crisis, or when we're all going to have health issues at some point, have health crisis later on in life. And so we really talk a lot about that when we're focusing on security and protection. And then those unexpected expenses. So we all have them. We all know, kind of figure out what they are. They're a little bit different for everybody, but I always tease, they come in 3. So you have an expected expense, and then another one hits, and then I'm always waiting for the 3rd one. I always think that they come in 3, and that's probably not the most positive outlook on things, but that's how it tends to happen in life. All right. Talking really fast here, but we're going to be talking about tax advantage strategies next, and we are ready for our next poll. So this slide did not get updated, Jordan. Oops. So what we're going to do is we're going to say that the first bullet is A, second is B, then C, and then D. So when planning for a retirement, which tax option saves you more money in the long run? Is it A, B, C, or D? All right, I think we have all, drum roll, please. Yes, we have all of the polling answers in. And we have such smarty pants here within the session. It was tax-free accounts. And that is absolutely the truth. There's a methodology out there, and there are a number of financial professionals teaching that the growth within those tax deferred accounts will exceed any tax obligations. And that the theory is that your expenses will be less when you're retired, so the income level will be lower when you retire. What we're finding is people are living longer, even with all of the health considerations we just mentioned. People are living longer, and then what's happening is our lifestyles continue to grow in retirement. How many people have you talked to that said, I want to travel when I retire? Well, clearly, if you're going to be traveling when you retire, you're going to have higher income needs. And then as your money grows, your tax bracket changes. And there's a lot of information right now talking about tax rates and tax cuts and tax increases and all of that. So you never really know what those tax brackets are going to look like when it comes time for you to use your money. So tax-free is definitely something that tends to win. But I will caution you, don't always assume that's the case. We always look at things a little bit closer, just making sure, again, that balance is extremely important. That diversification is extremely important. But we are going to lean into tax-free strategies in the long run, because would you rather pay, like this slide says, would you rather pay $62,500 or $169,500? I think we know what the answer is there. We all want to pay lower tax of the 62.5, right? Okay. Another comparison here, this one we're going to spend a little bit of time on, okay? This is a tax deferred account versus a tax-free account. And I'm doing a comparison. It's a very simple comparison. I don't have all of the variables in here for purposes of this conversation today. But a tax deferred account, you're going to be looking at your traditional IRAs, you're going to be looking at your 401ks. Your tax-free, some of these you're going to be looking at like a Roth IRA, or you're going to be looking at maybe an index universal life policy, which is life insurance, but yet it acts like an investment account. So we're going to be comparing these two, the tax deferred and the tax free. And we have a 29-year-old who's getting started, and his money is growing at a 7% annual rate. You know, it's usually a little bit higher than that, but for purposes of this conversation, we're just trying to keep things conservative and flat and level. So let's say they are going to retire at 68. They have a term insurance policy that's provided by their employer, and they want 47.5 when they retire. So we're taking these variables and we're going to play it out a little bit. So in a tax deferred account, again, it's a 401k. They had a company match, and the company provided term life insurance. This is very, very typical. I think we've all either been exposed to this or maybe been a part of a company where this has been the case for us. And then in retirement at that 68 age, decided that they could live off of the 47,500 a year, but they have to pay taxes because it is a tax deferred account. So they have to withdraw more money in order to cover those taxes. So their annual withdrawal is a little over 63,000. And so what happens? They're in that 401k. They had that term life insurance with the company that was a 30-year term. They ran out of money after 11 years, and they didn't have life insurance to leave with their family. So in some cases, in most cases, I'm not saying that they're going to let the life insurance run out, but if you are in that standard mode of thinking of life insurance provided by my company, and I'm cool because I'm in my 401k and I'm doing good there, you are doing great, by the way. Always maximize your company contribution. But there's more to the story than that when you're planning about financial security and financial protection. On the tax-free side, I just used an IUL, which is an index universal life policy comparison. They didn't have the company match in this IUL because companies typically don't match for those. They contributed the same amount of money as they did their 401k. And in this scenario, it is tax-free. So they're doing withdrawals from their life insurance policy of the 47.5 every year, just like in the tax deferred example, right? But in this case, this is guaranteed income. They're not running out of money. They can live to 100 years old. They're going to be withdrawing over $1.4 million in that scenario. And in that scenario, their family still receives $400,000 of life insurance when they pass. So it's a very compelling comparison when you're thinking about it. Now, again, there's a ton of variables that we did not talk about here, and it's really important to kind of focus on your own situation and map out these strategies that fit for you. All right, on a scale of 1 to 5, how would you rate your current knowledge of life, disability, and long-term care insurance? Do you have little to no knowledge? You know some basics, but need more information, a general understanding, you're fairly knowledgeable, or can you be teaching this class with me? Which is it? Let's open up the poll.
Malfunction on the poll. Can you guys add your numbers in the chat and I'll tally them?
Well, we got 2 polls that cooperated, huh, Jordan?
No technology.
I guess we couldn't
What?
ask for 3.
I tell you what, I'm clicking the button and it's not going through. Let's just add them in the chat. We will roll with the punches.
All right. I see people adding in the chat. Oh, Jean, you're very creative. I love that. I love it. I love it. All right. So we're going to go with, I'm going to use Jean's assessment. We're going to go 2.5. He's a 3.5, but we're going to go 2.5 as the consensus here with us today. So know some basics, but need some more information, maybe had a general information, maybe you talked about it like years ago and you need a refresher, that type of a thing. So we've got you covered. But I'm going to say, buckle up because there's a lot of slides coming here and there's a lot of information. And I'm sharing this just to dabble into it, to kind of re-expose you to these concepts. We're not doing deep dives in all of this. So if you're feeling like I'm flipping through things a little bit too fast for you, I got you on my, I'm going to move you over a little bit here so I can see the chat. I will definitely slow down and focus on some of these other concepts. So please, please use the chat. Let me know if you need me to stop, elaborate on something, and we will absolutely do that for you. All right. So when we think about financial protection, a lot of times we're going to take a look at the shield, right? So you've got these areas of the shield. It could be illness. Certainly it could be your life insurance. It could be disability. It could be injury. So these are the types of coverages that give you that shield of protection. Make sense? All right. So here's some terms just to kind of get more familiar with if maybe you haven't been looking at this stuff or haven't been exposed to it. A claim, it's what you file to the insurance company and you're receiving benefits under the terms of the policy. So you're getting those funds from the policy. Beneficiary is who receives the benefits of that policy. It's usually a life insurance policy that we're referring to. And then premium. So this is what you're paying on a routine basis. You pay this in auto insurance, you're paying this in either your renters or your homeowners insurance, that type of a thing. Policyholder, who owns it? So who is the policyholder? The person owns it, the person that pays the premiums. Your deductible is just that. You're paying that out front before anything is covered by that policy. And then a rider is usually these are special features or additional benefits that are added to a policy for specific reasons. Sometimes you get a free rider, but mostly you're paying extra on your premium for those additional features. So we got a question into the chat. Thank you so very much. Oh, good to see you in here. I am so glad you're doing well. I saw your social media post the other day. The question is, if my job offers a Roth 401k, should I do that instead of a regular 401k? Obviously, we're going to take a look at your situation and your complete financial landscape because it does come into factor. There are some variables. So we want to sit down and kind of take a look at things before we give you a very specific consultation on it. But 9 times out of 10, you're going to find that Roth 401k is going to be your best benefit. If you go back to one of the slides, we really kind of hit on that tax deferred versus that tax free. And so Roth will fit into that tax free. So if your employer provides 401k and there's a Roth option, that company contribution tends to apply to that Roth as just as a tax deferred option. So you should absolutely consider that as the right option for you. But again, there's so many different things that we look at before we make that decision. But 9 times out of 10, you're going to be fine if you choose that Roth. Thank you so much for the question. All right, this is where we're going to start to fly. So accident and injuries, obviously they can happen at any time. We're talking about, it could be something that maybe you don't have workers' compensation coverage. Maybe you're a 1099, a contractor. Maybe you have a car accident on your own time, those types of things. It's something that's going to help you. This is different than something that if it's an auto accident, this is different than your auto insurance. This is something that's going to be paying you. And usually they're paying you directly to help cover expenses that maybe your insurance coverage, like your employee benefit coverage, your health insurance, those types of things may not cover. Okay. And so a lot of times these are, dollar amount payouts versus a percentage payout. Accident insurance, I think I just hit on these. I did. So like, for instance, if there's injuries sustained during the event, you've got some hospitalization, things happen in your life outside of paying that doctor bill, right? So if you can't work, you may not have paid time off. Obviously, this insurance, well, maybe not obviously, but this insurance can kick in to help you during those times. Okay, so we hit on that. I got ahead of myself there, didn't I? So critical and chronic illness is another one. This works very similar than what we just discussed in an accident, but this is if something happens to you that's a little bit more long-term. If something is a little bit more long-term, you may have to really pull back maybe in your work schedule. You might have additional expenses in your life because you can't do everything that you normally do if you have children or other obligations. And so in case of an illness, this is something that will kick in and really help cover those types of things. It allows you to really focus in on getting better versus the stress of how am I going to put food on the table. This works a lot like deductibles and copays. But the cool part is you do have some flexibility and freedoms of using those dollars. So if you have to travel to get treatments outside of the state or the city, you are able to get coverage for that. A lot of times in insurance policies, they'll say, we'll give you physical therapy, we'll give you 5 sessions, but you need more than 5 sessions. So something like this can kick in. Also, it does help protect you if you lose capabilities of 6 activities of your daily living. So as you're getting older, or maybe you have an illness that is debilitating, you may not be able to bathe yourself, dress yourself, and those types of things. And so this can also kick in during those times and be able to give you the support services that you need. Life insurance with living benefits. So I think most people know about life insurance. So term life, right? So buy term, invest the rest is I think what Dave Ramsey says. Although I'm not a fan of that, term life insurance absolutely has its place, but permanent life insurance is something that we really lean into a lot of times, depending on what is going on in somebody's life. And there's many reasons we do that. But and then we want to make sure it's targeted to the person, of course, but living benefits are a part of a permanent life insurance policy. And living benefits are some of the things that we just talked about and in the accident and chronic and terminal illness area. And so what it does is it basically pulls from your death benefits in order to give you living benefits at the time of need. So what happens then is when you pass, your death benefit has decreased. However, you have been able to cover some of those costs. Short-term and permanent disability. So I think a lot of people might have been exposed to short-term disability in their work life. Short-term disability is either something that's offered on a voluntary basis, and in some cases, employers will pay for it. And there's very specific terms and conditions that apply to disability benefits, and every policy can be a little bit different, but it usually provides you with a specific amount of time, and it's usually like 60 to 66%, sometimes a little higher, of your income. Well, that's great and all, but what happens with the rest of your income? We just talked about replacing income, and if for some reason you're not able to work, can you live on 60 or 65% of your income? Many people cannot. A lot of times you're kind of living paycheck to paycheck. And so that's where this comes in. There's also permanent disability. So if something, God forbid, happens where you are disabled and you are not able to work anymore, there's certainly something to do with the Social Security Administration. They do have disability benefits. Those are extremely challenging to qualify for, and the length of time for the application is quite lengthy. So that is absolutely a pathway that needs to be pursued with. But if you have a permanent disability policy, that absolutely gives you the peace of mind while you're working to obtain those benefits. My close friend from elementary school, she's going through the process right now. She's had a very, very tough time, and she's still she's in the 2nd year of her application for permanent disability with the Social Security Administration. She has her hearing next month, so pray for her. Okay, is it enough? We just talked about that. Usually it can be, it depends on your situation, but Social Security disability benefits are not going to be anything that you can rely on to support your current lifestyle. So think of it this way. So permanent Social Security benefits will be a nice coverage for you. It's there for just that. However, you will have to decrease your lifestyle pretty considerably in order to live off of Social Security disability benefits. And then if you want to think about things like, let's say you need to move and you need to get a mortgage to move, your debt to income ratio is going to be completely off, and you will not have the opportunity maybe to qualify for that mortgage when that time comes if you need to move. So when you're thinking about, is it enough? Obviously, you want to think about your day-to-day expenses and what you need in order for you to live on. But you also have to think about other things that will come up in your life when you're on disability that you may not be able to navigate through because your income level doesn't support that need. So that is something to consider when you're looking at disability coverage. Okay, here it says you're going to replace 60 to 80% of your after-tax income. Remember, we were talking about a short-term disability and employer is around that 60 to 66%. So that for a short period of time, that might just work for you. But for a long-term period of time, that definitely would not work. All right, untimely death. This is, I have a business partner and she basically says, what are the guarantees in life? She said, you're going to pass. That is the guarantee in life. You're going to die. And I don't say it with the flair that she does, but that is the hard truth that we all have. And so we definitely need to protect our families and our beneficiaries from our untimely death. Certainly we will be passing away, but this is something where maybe it's accelerated and unexpected. And so what we want to do is just really kind of focus in on what our family needs are, kind of going back to how we calculate it. When we sit down with folks, we're going to make sure that we have taken a look at their specific situation. Income, how many years do you have to replace your income? Again, it's between that 10 to 15 years. What are your debts? What are your obligations? Do you have to cover for, maybe you want to make sure college is covered and those types of things. And so we want to make sure that you have enough life insurance. But when you look at the statistics of those that don't have life insurance, it is alarming. And then something that I see more so than not having life insurance is people thinking they're taken care of. I've got a term policy. I'm going to be fine. By the time my term policy ends, I'm going to have enough in my 401k to take care of that and leave for my family. Well, we just proved in the last couple of slides that methodology tends not to work because of tax obligations, inflation, and there's just a lot that happens. You cannot necessarily self-insure. And the unfortunate part is people do realize as life passes, because time passes really fast. Every year I say that. How is it Christmas already? Those types of things. If you think about it that way, you could be terming out in your insurance. Let's say you have a 20-year term, 30-year term. And you're thinking to yourself, okay, I've got about 5 years until that term's out. Okay, now I need to figure out what I need to do because I don't have as much that I thought I was going to have in my retirement accounts in order to leave for my beneficiaries. Well, guess what? It's too late. You needed the underwriting now in order to be able to qualify for your life insurance needs down the road. And so it is very important to, again, plan and just understand term is great. Maybe term is short term. You maybe think about getting a convertible term policy so you can afford the premium. But then when the time comes and you're converting it into more of a permanent insurance policy to help you with that long-term need. All of this we look into, and we want to make sure we take a look at your financial landscape, and we're customizing your roadmap to not only your needs and wants, but also your financial situation. All right. I just didn't hit return, did I? Okay, so two types of life insurance. So I've hit on the term insurance. This is a very specific period of time. This is what you have through your employer. In most cases, now sometimes there's something called a whole life policy that does fall into the permanent insurance, but most cases, employers can buy term insurance cheap. They usually bundle it with their health insurance. They may have a secondary insurance carrier that comes in just for life insurance, and you can buy some for your spouse. You can buy some life insurance for your children, and then the company will pay for a portion of that life insurance. In those situations, these are term policies. Now, when you leave that employer, that insurance ends. You can, in some cases, do what's called portability and port it over into an individual payment situation. The problem that exists in that scenario is that it's really expensive. And then also there are some underwriting rules that could potentially apply in the porting process. So that's something to think about. And you're like, oh, well, I'll just go to another employer. They'll provide life insurance. Again, it is term insurance. It's still great insurance, but it's not going to get you that long term. So you want to really kind of think about that. And then there's a calculation that we can do together. Like I mentioned, we also have a worksheet we can send out that really helps you understand kind of what that amount of insurance you need. And so what happens too with term life insurance, in many cases, people are like, I'm covered. I have life insurance until I'm 99, and I know that I will pass before that. Everybody in my family has. Okay, got you. Well, look at the small print, because a lot of times in those policies that are in place for term coverage until you're 95, 99, whatever that age is on your policy, sometimes it's 89. Look at that, because a lot of times at age 60, the premiums start increasing and the death benefit starts decreasing. So people don't, I mean, who knows where their insurance policy is? There's a very few people that can just know where their insurance policy is and grab it up and take a look at it. Now, a lot of times we can log into a portal. We have a file in the file drawer and we can pull it out, but it is extremely important to know what kind of term insurance you have and what happens down the road when you need it the most. Again, going back to those annual reviews, whether you do it with a financial coach or advisor or you do it on your own, you must at least do annual reviews and take a look at that. Another thing, when you're doing annual reviews and getting that top of mind, look at your beneficiary. Make sure your beneficiary is straightened out. All right. So, and then the term, you kind of think about this because it's cheap, is when you have a lot of protection, right? Your mortgage, you don't have, maybe you just moved, right? And you need a larger amount to cover that, to cover the mortgage. Maybe it is the kids are young and there's so many expenses and you need that protection, but you can't afford something that has that investment component to it or those living benefits component to it. So you buy term. Not a problem. Just focus on the convertibility of it. All right. Any questions so far before we hit on perm insurance? I know it's exciting stuff and it's action-packed, people. All right. Drop your questions in the chat, your comments. I want to hear from you, because if you need to know different information or you have questions, I am here for you. So please, please, please put them in the chat. All right, permanent life insurance. So this is the coverage that I referenced a little bit ago, and it's really talking about something that's just in place. For as long as you pay for it, you got it. And permanent insurance is going to work a little bit differently than term insurance. Terms out. Permanent is permanent. And so it's literally that difference. Inside of a permanent insurance policy, you're going to find a few things. I call them bells and whistles. One of them is cash accumulation. So part of the premium that you pay on a monthly basis will go to, will grow, and it'll grow based on an index allocation strategy. And so it could be the S&P, we can do NASDAQ, Barclays, whatever that particular program runs off of. We can actually diversify different investment strategies and those types of things, but it's inside of an insurance policy. So the spiffy thing is you get the growth, you don't get the losses. So something to know about permanent policies, you're going to get caps. And so if you follow the market, a cap versus uncapped strategy over a 20-year period, the cap strategy will win every single time. But if you have a shorter period of time, we're going to look really closely to see if that cap strategy is going to work for you. A lot of times it does because it's a shorter period of time. You're mitigating that risk of losses during that period of time, but not always. That's why we look on an individual basis. The second bell or whistle that's in this are those living benefits that we mentioned. So you have them baked into the permanent policy a lot of times where if something happens to you, they then pay. I had a story where a woman was diagnosed with cancer, and she was battling cancer, and she was really having a hard time working, as you can imagine, and she was on her own. And so she contacted her insurance carrier and said, I need to stop my payments. I can't afford my payments. This is what's going on. And the insurance agent that was manning the phones that day gave her incredible news because she had living benefits. So I get teared up whenever I talk about her. So what had happened is she received a check in the amount of $114,000. And she was able to not only focus on her health, but she was able to fight the cancer and find the treatment that worked best for her. She quit her job so she didn't have to worry, and she lived off of that money until she became well, and then she returned back to the workforce. So those premiums on a monthly basis also stopped. So isn't that just an amazing story? And when you want to just deliver that check to her and just be able to be a part of that experience with her, and what an incredible experience. So that's what a permanent life insurance policy does. And then the death benefit, just like the term life insurance, there is a death benefit that is a part of the plan. And in some cases, there is a situation where you're still accumulating on the original balance, even when you're pulling life and living benefits. So you still have growth on the cash value of the account, even though you are using those living benefits. So kind of spiffy, right? That's why I call them bells and whistles. All right. Any questions about that? Okay. We have a quiet group. Okay. We hit on all this. Oh, look at me. I should have been hitting return. How many times I practiced this, guys? So what I want to do is open up the floor to a few things. I want to know questions, and I want to know key takeaways. Obviously, I've said how many times this 45 minutes we've been together about how important it is to have an individualized plan. So we just want people to make sure that they're thinking about the things they should be thinking about in their financial landscape, but really working on their situation, being very specific about their needs and wants, their goals and objectives, their family. And then what we do when we develop a financial roadmap for someone, we meet them where they are, and then we define kind of what those steps are. If somebody's not ready for an investment strategy, that's okay. We will help them no matter what it is. It could be saving an emergency fund, and how do you maximize your money during that time? It could be to rebuild credit or a managed debt. It could be to maximize an old 401k plan. Most people will just roll it over to their current 401k plan, not realizing that they have some opportunities to mitigate tax exposure and generate or create a guaranteed stream of income. So everybody's a little bit different, and we treat everybody to a custom plan no matter where you're at and where you're starting. We work also with the most savviest investors. That's my story. I'm not a savvy investor, by the way, but I was working with a financial advisor. Well, I am now. I wasn't then. I was working with the financial advisor, doing everything that I thought I was supposed to be doing, my husband and I had acquired a business 13 years ago. So outside of this business. And so I thought I kind of had the boxes checked. And that's why I do what I do, is because I met with one of my clients in my other business, and she sat with me and she provided me a custom roadmap. And she did for me in that session what my financial advisor didn't do for my husband or my business, my husband and I, or my business in the previous 20 years working with them. So that really opened my eyes to the power of individual programs and just making sure that we are staying in touch with those relationships every year. Some relationships we even meet on a 6-month basis, depending on what they have to accomplish. So what with that, we got, okay, let's see, we've got a question. Jean, does the living benefits reduce the cash value? And I am curious about the cap or limit, which covers avoiding incurring losses in a down market. Yes. So Jean, so there's different strategies and there's different programs. So what we do is we're going to customize it. We don't sell products here. So we really lay out a strategy for the person. So let me go to your first question for the first part of your question. Does living benefits reduce the cash value? It does not. It pulls from the death benefit. So your cash value accumulation is what still grows at the base amount, your benefit base. But the death benefit does decrease based on your living benefits. But it's a calculation that happens year over year. So let's say in the first year, you're using those living benefits, like the woman that I was talking about. By the way, she had only been in the program or the policy for 2 months when that paid out at $114,000. So so it really depends on the time then you have that payout, and then when you have the money accumulating, in that period of time you have the money accumulating until you choose to either access that cash accumulation or you need to use that death benefit. So that's one. And then on the caps, when you are avoiding incurring losses on the downtime. So when you're looking at an IRA and you look at a Roth IRA, you look at a cap and an uncapped strategy, you can actually Google it and find the same information. And you're going to look at a 20-year. A cap strategy will always win in a long-term game. Sometimes it will win not sometimes, but it will win in a short-term game depending on what your goals are. So we're going to look at that differently everywhere. Some of the programs could cap at 12%. Some of the programs could cap at 10%, but yet you may have some benefit bonuses or those types of things. So there's always those numbers to look at, and it's everybody's situation. We're going to look at your goals, and we're going to look at your financial needs to make an informed recommendation on what solution works best for you. Good question. All right. So any other questions? If not, I want everybody to drop in the chat what their key takeaway was from today's session. And I will wait for a little bit while Jordan sings some hold music. Come on, Jordan, sing some hold music.
Da, na, 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 da.
It's like Jeopardy, right?
That's all you're going to get from me today.
Yeah. So Jean, pop in your biggest takeaway. Lisa, pop in your biggest takeaway. Who else do we still have in here? We might still have Susan. She may have had to get back to work. So everybody pop in your biggest or your takeaway or something, a fun fact that you might have learned today from the conversation, or drop in your question. Jordan, what about your key takeaway?
I was surprised to know that the story that you told with the lady who used her living benefits, she'd only been in the program for a couple of months. It sounded like she had to accumulate it for a couple of years. So that was surprising for me.
Yeah, that's a pretty cool feature. And that's because it does leverage that death benefit of the policy. It's very good. Very good. Jean, what is your key takeaway? There you go. Yeah. And you know what, Jean, when you look at your term life insurance, just take a look at the convertibility of it. So that's the feature that you're looking at to see if there's you're able to convert it. So they're not going to automatically convert it for you. They're just going to increase your rates. So yeah, that's something I would, when you're pulling your policy, take a look at that first. And then we can definitely go from there. And then if for some reason it's not convertible, then we would take a look at some of your other accounts that you might have in place right now and see what we can do in order to move maybe into a high yield annuity that could be more of an accumulation for you to cover for that insurance loss in the term policy. So a lot of times when premiums are increasing on the term policy, if it's not going to be convertible, you still have to figure out how to make that, cover that life insurance piece. There's some strategies that can be done that only need about a 5-year before passing. So if, not saying you're planning your death by any stretch, but it can still be, it could still be solved for in a shorter period of time without those high premiums of the term insurance. Okay, let me see here, make sure I go back. So the difference between a 401k and a Roth 401k, good question. So a Roth 401k, you are going to contribute your money after you've satisfied your current taxes. So your taxes are taken from the current tax bracket you're in today, and then you are investing your money into the 401k. Where a regular traditional 401k, it's called tax deferred. And so they are the government, it's a government plan, by the way, and they are giving you the ability to invest those dollars before you pay the taxes. So you have to satisfy the tax obligation down the road. Also good to know on the awesome. Yeah, difference between term and perm is always good. It gets a little bit tricky. When your client with cancer received the living benefits, did her policy still remain active? Absolutely. Yeah, it's a feature of the perm insurance policy. And it is 100% still intact. The premiums stopped. She received living benefits. Again, you can kind of think of it as a loan on the death benefit, if that kind of helps you in some common terminology. And so then what happens is, again, the cash accumulation continues to grow. Cash access could be limited, but the death benefit then can return over time as that cash accumulation grows. It depends on the policy features, though. So it's something to really do a deeper dive into and find the right policy for you. Awesome. I'm so glad you were able to learn about the different life insurance options. There are quite a bit of options out there. And I had no idea that I would ever be using a life insurance policy as an investment vehicle. That's something that just shocked me to death. And so I thought I knew it, but I didn't know it until, and like I said, until the gal I met with, her name is Shirley. She's now my business partner. I sat with her and she shared with me all of the financial vehicles that are out there. And it's interesting because when there's high wealth, you typically know of these, but the ones that need to know it most, it's just not known to us. And I think a lot of times it's because financial advisors are limiting to who they will work with. There's usually minimums of what you either earn or what your net worth is before you work with someone that can expose you to these types of things. All right. Well, I will thank you for your attendance today. We do a Wealth Wednesday every single month. Please check us out. Follow us on social media. We are under Unique Growth on Facebook and LinkedIn, TikTok, and Instagram. And Jordan's going to laugh at me right now because she handles all of this for me. But please follow us and we will feature these future sessions. And whoever invited you today, make sure that you stay connected with them and we will talk with you very soon. Have a wonderful day. Happy Wealth Wednesday.